Hello everyone, this is Dan Hussey from ElliotWaveForecast.com. I'm the host of the live trading room from 11:30 a.m. Eastern to 1:30 p.m. Eastern at ElliotWaveForecast.com. Today's video is entitled Trading Inflection Zones, and we're going to be showing you how you can manage risk through actual execution of trades. This is a technique that we highlight daily in the trading room, and is really, I think, what makes it special and a great addition to the ElliotWave Forecast site. An inflection zone is an area of participation of either bears or bulls in the market. This is where buy limit and sell limit orders are actually resting. Those are the only types of orders that can stop a market. Remember, stops, market orders, they all create an up or a down tick when executed. So a limit order doesn't actually move the market. It is there to try to stop or slow the market. It's an area where you're able to hop in on a wave structure, but it's not defined by Elliott Wave. You'll see today how it is pure price measurement and has nothing to do necessarily with Elliott Wave. Is one of the key technical indicators we have in our belt to help us identify and confirm Elliott Wave structure. And is used to manage risk by professional traders by either getting free or trailing stops. The idea is that it's an inflection zone. It's an area where there's a statistical probability of the market to move in a particular direction from. Thus, you can use that particular price movement to actually execute trades in order to manage your risk, and we'll show you how to do that. There's two types of inflection zones. There's the Fibonacci retracement zone. Entry is the 50% line. Invalidation below the 61.8. I commonly use the 65% line to confirm invalidation of a zone. First target is a 38.2. If you notice, that's equidistant from your entry point, the 50% line, and where the 61.8 line is. That's where the in equal movement to the upside or downside, depending if it's a short, would be. And the target for the trade is a negative 23.6 line. In other words, a break to new highs or lows. Equal legs extension zone is the other type. Entry is 100% extension. So now we're using a Fibonacci extension tool. Invalidation is below the 123.6 line. It's very similar to the 61.8 line mathematically to the 100% line. And then the first target is a 78.6 or 76.4 line. It's up in the air. The idea is that they're very close to each other. That is the area where the market should move from the 100% line back towards that area. That's the actual inflection. And a target is a negative 61.8 line, which again is brings you often into new highs. So some examples. Here's the S&P 500. This is a 4-hour chart of 2014, price action. You can see halfway back for the year, just a 50% pullback for the year, traded on the 13th or 15th. It was a weekend. 50% inflection zone was the buy. Your invalidations below the 61.8 line, and targets are actually well above. And let's take a look at that now. Here's that same chart. 50% line, again, the 1812s were your entry. You can see how the initial reaction off this level is up and into the 1831s, which is where your 38.2 line is. So this is the actual inflection we're referring to. It's a move from the entry zone to the first target. And that's what you're looking to capitalize in this type of trade. Because remember, that distance is precisely the same distance between your entry point and where your stop or the invalidation is down at the 61.8 line. The idea is you enter the trade, you get free by either taking half the position off at this first target or trailing a stop when that first target is hit. Okay? And by having the invalidation zone be equidistant from where your potential first target could be, if you take half off at +1, we'll call this +1, right? And your stop remains at -1 for half the trade, the market would have to fall all the way back down to -1 for you to get stopped out. However, you shouldn't take a loss on this because you've already booked +1 on the trade, right? And of course, the target now is up at a 1930. This is a technical area of, an extension, you could call it, for the market to press into. Now, there's a lot more here, and how these and how to find these zones and properly draw fibs that I'm going to be unable to cover today, but you guys will just have to tune into the live trading room to see more of how these trends develop and how you make the decision that this pull itself is exactly is a correct entry point for the market. All right, let's take a look at what an extension looks like. I have up a 4-hour chart of the Euro Aussie. So this is a 100% or equal legs. It was one of the best equal legs trades we've actually seen in this market for some time, or any market for that matter. I mean, particularly for a 4-hour trade, this was very clean, very good. So the idea is we have a corrective 3-wave structure to the downside, right? Well, on that third leg, in a typical A, B, C structure, right, you look for equal legs very often. Now, there's some caveats here that we're not going to be able to cover, like I said, but the idea of the equal legs inflection zone is that the 100% level is your entry, the 76.4 is your first target, and of course, equidistance of those two is the 123.6 line, which is your effective stop on this trade, or the invalidation. Now, you notice how the inflection occurred from that 147 level into the 149. So there's a 200 pip inflection zone. And for most traders, these inflection zones, maybe you don't care to take the trade all the way to the negative 61.8, which is the profit objective up around 160 from this type of inflection. But the idea is you can get into a trade, take a first target, or even scalp it in this inflection zone, or trail a stop, depending on your particular trade style. I prefer the +1 -1. In other words, take half off, right? Leave the balance remaining as a free trade, and have a great opportunity for a massive massive reward to very small risk of a chance for this market to move all the way into 160, which is roughly 1,300 pips for a 200 pip risk, which is quite good in terms of statistical odds for a trade. So again, this is the Euro Aussie 240-minute chart looking at 100% equal leg inflection zone. And there are ways that both these can play out and play together into zones. I'll just very quickly look at, the next Fibonacci pull on the Euro Aussie is at a 145, and if you notice, that's right where the invalidation is for this equal legs. We see things like this all the time. Sometimes they align perfectly, and those are just little examples of ways that we can find levels of greater participation in the market by knowing how to use inflection zones and how to trade them, because they're not there just for an entry point. They define an entire trade setup and an entire method of execution to manage your risk. And that's the most important part of any trading plan, is how do you manage your risk, more so than your entry, stop, target. The execution to minimize that risk, to bring to get free, to trail stops, whatever it is, that's how you get a statistical edge that can turn a system that only wins 40% of the time into a highly profitable system. So you don't have to be right every time when you get free and when you manage risk correctly, and that's the important part of trading. You don't even have to be right the majority of the time. You can still be a profitable trader. So that being said, have a great day. Hope we see you in the live trading room. Hope you check out ElliotWaveForecast.com. We have a lot to offer. And this is just one of the, one of the aspects of the live trading room that we use to confirm our Elliott Wave structures. And of course, one of the methods we use to manage the risk for trades. So I hope you've enjoyed the video, and we'll be back with you as price action develops.